Okay, I suggest we get started. I'll tell you something about myself and the company in a minute, but I'll first allow the other panelists to introduce themselves and then the firms they represent.
Thanks, Adam. My name is Daniel Dobrev. I'm part of Fortress Investment Group, which is a global diversified investment manager with just over $50 billion of assets under management. I sit in the specialty finance team in London, where our primary mandate is to provide asset-backed financing to non-bank lenders. That could be through senior, stretch senior, mezzanine financings, forward flows, or just purchasing portfolios of receivables.
Hi, my name is Fabricio Mercier. So I work at Winyield, which is a credit fund based out of London. It was created by actually entrepreneurs in fintech. We understood how difficult it is to raise the first lending transactions. So we have a one-stop shop solution providing capital, SPV accounting, regulatory compliance, and so on. We do transactions between 0 to 20 million. We deployed so far about 400 million.
Hi, I'm Regina Marinina, and I'm working also in London in a regulated part of the Mount Street, and my team and I, we are covering all kinds of financial modeling, cash flow modeling, valuation, asset liability, and structuring of transaction for funding purposes. So we are majority of us coming from former WUDL asset-backed department, and so very much in the securitization space, but also very strong on the asset side as well.
Yeah, hi everyone. My name is Luca Frignani. I'm CEO at EXALOAN, and EXALOAN is specialized in developing AI-based credit risk analytics. We work with both non-bank lenders as well as institutional funders, and we provide professionally managed access to granular portfolios of loans that are originated in the SME and consumer lending space, from non-bank lenders in most different techs. Yeah, for those of you who do not know me, my name is Dobrev. Some may know me as Adrian, which is my original name. I'm from the Netherlands. I work for Chartered Investment Germany. We provide several types of services. The most important one being securitization services, where we provide unitranche securitization services. So one of the things that we do is to wrap receivables that are originated through loan platforms. So that's the reason why we're an associate member of the DLA. Very nice, I must say, to see so many familiar faces and also to see so many people attending. And I think we're gaining traction even more every year. So I'm very happy this morning that there were a lot of interesting talks, but none of them mentioned AI, which surprised me. I think it should be one of the main topics. So that allows us to discuss this very interesting topic. Luca, this is your home turf. Maybe you want to kick off. Do you use AI? How do you use it? So first of all, we're practitioners, and I'm not an academic, so the intellectual level is probably... So obviously AI is the buzzword of the year. I think there are many interesting use cases that have been trialed or are already implemented, both on the origination side of things as well as on the analytics side of the portfolios. So probably the most popular ones are actually, fraud prevention, and then also using AI sort of credit scoring models to predict probabilities of default. Even though I must say on the latter that there are obviously also some regulatory boundaries to what you can actually do with AI, predominantly because obviously the regulators still have kind of the view that the models that are used for a credit decision need to be interpretable, and that's kind of by the nature, it's very restrictive on a certain family of models, and so restricts what you can do. Okay, let me ask one question. Do you use the AI yourself because what you use to originate the loans is a platform, or do you analyze the AI models that the platforms use? So it's both. We obviously due diligence the originator and also how kind of their credit scoring is performing. But then we add a second layer of essentially a default prediction based on models that we develop ourselves.
We've used AI solutions actually increasingly, maybe already for at least 1.5 years. Since it started, it was not blocked, but now we have AI policy, and we have also responsible use for AI in risk management, but also in the evaluation and in modeling, especially also to finding the right assumptions for the models based on a pattern which then analyzed by AI and reviewed by human. So I am advocating for responsible use of AI. So we do the evaluation, for example, for credit-based platform lending investments, and there we see, for example, that different platforms that probably all use AI, but they provide for the same, completely different pattern when originating the loans. So, for example, one platform would be based on expected loss, and another one will be on, like in US, on FICO score. But if I would use the same valuation model for the both platforms, there will be non-really unreasonable results, because they are originated on completely different platforms and completely different logic. So to analyze and to underwrite at our end and remap of that, it's something which I find very interesting, but it also, I think, a way to improve and to synchronize, make it more transparent going forward.
So we use quite a bit of AI recently, mostly for data gathering and data cleaning. So it's not involved in any of our create models yet. I can say 3 interesting facts. I can share 3 interesting facts with you. First, we look internally at the KPIs of how much manual time we spend on one loan. So before, when everything is manual, we take like about 10 hours per loan. So that includes everything, KYC, gathering the data, when it's manual, inputting them, etc. With automation, so that's what a lot of digital platforms do. We went down to about 10 minutes of manual work per loan. And with AI, we got to about 15 seconds for normal loan. So it's actually quite revolutionary, especially on the data cleaning, making sure that things are like very, very accurate. So that's the first thing. The second thing to share with you is that this is surprising, but AI is not that fast. So we recently had to upload to manage a 2 million loan portfolio, so very granular. And everything is automated with AI, but it took our models, even though we have 4 dedicated servers for that, it took 48 hours to run through all the checks that the AI had to do. So it's not real time. And that's really important to consider. And the third point is, if you think about, we think AI, it's intelligence, but anytime there's a special case, AI doesn't help. Like we didn't manage yet, at least at our level, to use the reasoning part of AI. So in a nutshell, to summarize the finding, we found that AI is actually a really good improvement in terms of efficiency. But it's more raw power as opposed to, the kind of an artificial intelligence per se that helps you to make better decisions. At least that's our experience.
And on our side, and my personal opinion, I'm still skeptical to neutral at best on the practical use of AI. We do use it for manual operational and administrative tasks, just making them more efficient and quicker, as Fabricio said. But in terms of generative power or in terms of analytical power, I don't think we're really, really close to seeing any practical use. Just to give you an example, right, of what we're doing, right? We can use it for very simple things like, I don't know, extracting a table from PDF into Excel or other data source. Like that's something that could take a lot of manual time, but now it's a 10-second exercise. We could do it for data analysis and data cleansing, as Fabricio said. The other thing is if we have a big document suite, right, and asset-backed transactions typically have a facility agreement, but then 10 or 15 ancillary docs, you can query the doc and ask it some questions. But the moment you try to see if it's learned a given concept, it hasn't. So, for example, like having an unused fee in one document and then a non-used fee in another document, which are the exact same concept with very similar definitions. It can't really, make sense that these are very similar. And then, for the purposes of our credit analysis and credit decisioning, we are not relying at all on AI yet, and I think we're probably some time away from that.
Is any of you or any of your firms doing some sort of, let's say, evaluation on how manual credit scoring works versus AI in order to, let's say, check whether this is something that can be used going forward or to, on the other hand, exclude mistakes that the model might make?
I mean, it's part of our kind of loan book DD. So irrespective of how an originator comes up with their credit score, we always look at kind of predictive performance and then, basically kind of these receiver operator characteristics that are used in order to measure kind of type 1 versus type 2 errors in predicting events of default. And then usually the outcome after we have processed the book with our suite of analytics tools, we then make a decision, does our AI-based credit scoring add value on top of what the originator is doing or not? So that's something that we look at.
Okay, and full disclosure, at Charter, we do securitization, so it's not credit scoring that we do. And we only use AI also to search documents and look at past transactions when we're looking for certain information. And we don't use it for credit scoring, but that's not something which is part of our core business. Okay. One thing I think we heard a lot about this morning is the fragmentation of markets across Europe and the due to regulatory issues. It's something that our panel discussed as well when preparing for this event. I think it's very fascinating, and of course it comes into play in different levels. So the scaling of certain models by platforms across Europe, but also the restrictions on fundraising, etc. Maybe any of you who wants to share their views on this issue?
I can kick off on that. I think that's a big challenge for European-based originators, and I think it's easier to be, let's say, a US originator than a European originator because it's much easier to scale from one state to another and to the other 49 states. Yes, different states in the US have different regulations and different specifics, but they share the language, they share the federal regulatory framework, while in Europe you can have like two neighboring countries with completely different regulatory frameworks, legal frameworks, languages, customer behavior, whether that's consumers or SMEs. And I think that's really, really challenging in terms of scaling a product and scaling a platform. Right? On the SME side, you have regulated and unregulated jurisdictions. In terms of consumer, you have countries that have usury laws that are more stringent than others. Also, like how you can set your sort of maximum interest or maximum fees in a consumer product varies quite a bit between different jurisdictions. So you can be very successful in your home turf, right? Have a very good product, have a very good sales team, but the moment you want to go out to a different market, first of all, you need a local team with boots on the ground that speaks the language. then you need a tax and a legal and a regulatory team that understands the local market, and you need to do a lot of prep work, months if not more than that. And then you can launch and still not have the proof of concept. So I think from that perspective, it's very difficult to scale, at least for most products and most asset classes. And yeah, I think that's definitely been a challenge for some platforms that I've seen, that at some point they just cap out on what they can do in their home market. But at the same time, is it really worthwhile trying to go into a market that you don't know just for the sake of getting incremental volumes? Oh, that's a very difficult question to answer.
Yeah, I would like to add that in the past, we've also seen some platforms that went abroad trying to gain market share in markets that they weren't really familiar with, which then led to lax underwriting standards, and that then backfired. So I think that's something to keep in mind for everybody, when making such decisions. Sorry, Mercier.
Yeah, sure. So it's a really a difficult one. I think we just need to be pragmatic about the fact that the regulation problem is going to stay. So yes, the issue is, if you want to do a deal on like 4 or 5 different regular jurisdictions, it's going to cost you $100,000 in legal opinions. And it's going to be like that maybe at least next, I don't know how many years, but I don't see any change. And I think you saw it at the last panel about regulation. So the question is, how do I reach a level where I have a profitable business? I can get, a banking facility with the big banks. So maybe you need 100 million. How many jurisdictions do you need to get to 100 million? So that's really the question I really advise people to look at. So don't go for 20 markets. Go for do I need just the UK and Holland, for example, which are unregulated for most parts, to get to my 100 million? And once you are there, you can ask yourself very different questions. You're profitable. You can actually burn more cash to go to more niche markets where the yield compression is going to be less. So I think that's the right approach. If you take the 2 biggest lending company recent biggest lending company that made it, like Afterpay and Klarna, actually they started in their home market to try to get somewhat at a scale, and then they went straight to the US, as a colleague just mentioned, and that's the second strategy if you're really going for a product that requires mass market.
I can only add that working with a European investor in different marketplace platform found that it's indeed, they want to do many lenders, think about 27 platforms in different countries to have really well-diversified portfolio, but the cost were so high to get approval in each jurisdiction that they went to US.
Yeah, I think then obviously these are all commercial aspects, which are the main ones. I think then from an infrastructure and IT or data point of view, given that we need to also be mindful, where data is stored, how it's processed, and so on. I think we have a bit of an insulated environment in Europe, but then also if you're looking at expanding beyond the pond or in other jurisdictions, then that also comes into play, that basically you need entirely different IT infrastructures and kind of redundancies just to make sure that you're compliant with, local data processing laws. So that can just add additional complexity, which I think is to everybody else's point as well, that, a sort of geographic expansion should, I think, prudently only be done once it's actually really worth it. But it is a pretty big task.
Yeah. Okay. Interesting to hear that so many platforms are also looking at the US. I'm a bit surprised. I didn't really realize that. So that's very interesting. Are there also opportunities, because the conditions for the interest rates that clients will have to pay for a certain product, they vary immensely from the non-regulated Dutch market that you just mentioned, where insurance companies set up their own platforms to do just mortgage loans, at maybe 3.5%, going all the way to, I don't know, high double digits for consumer lending. I think the span isn't as wide in consumer lending as it is for SMEs, but I'm always very surprised to see how big the difference is in funding rates that clients have to pay. I guess this is due to the fragmentations. Anything that you would like to comment?
I mean, based on what we see, it's maybe less due to specific fragmentation in terms of jurisdiction. But from what we see, it really, the main driver is kind of the originator and the specific borrower niche that they're catering to. So yeah, what we tend to see is basically, what types of, what loan types, and then also what specific niche is that lender targeting, which determines also the underwriting quality and kind of the track record. Those are kind of the main drivers of ultimately also the funding rates that can be achieved in the market. So from what we see and from kind of the loan books that we analyze, I would rather say that's more down to actually originator performance rather than anything specifically tied to jurisdictions.
I would add to that also volumes, right? The more scalability you have. I mean, doing a 20 million deal or doing a 200 million deal involves pretty much the same amount of work. So maybe someone out there will be more amenable to deploy capital at a low funding rate if they can get a larger absolute profit from that, as opposed to a larger relative return or relative yield. And then the other thing, it depends on the cash flow profile as well, right? Maybe certain assets are more attractive to certain investors, right? Insurers may want some like longer term, more predictable cash flow, while other investors may seek sort of a quicker return with more upside, right? So it really depends on the profile of the underlying assets as well. But yeah, those are the things that I think drive ultimately the cost of funding.
I found it actually really surprising what we can find on the market. I mean, the UK has a lot of alternative lenders. So why are the rates higher than in the most other markets and regulated on the B2B side? So why is it higher? And actually, I mean, don't have the answer to that, but there's maybe a couple of points to share. The first one, I think it's cultural. Like the British entrepreneur is much more really looking at it on the relative value. So my opportunity cost is 40%. If I can get some money at 20% really quickly, I take it. The French client is going to say, oh my God, I would never pay more than 10% for that, irrespective of my opportunity cost. So that's one point. The second point I would say is the offer and demand of money. So you have massive savings in Germany and in France. This actually is clearly pressurizing down the spreads, whereas in the UK, they are not saving that much. So that's the second point. And then the third point I would say is the complexity. So if you are a very complex business in the UK, you get funding quite quickly. Okay, it's expensive, but you have like 5 people in next week providing you a term sheet. They understand your business. They've done this for years, etc. In France, you better take the Eurostar to go to the UK to find your term sheets.
No, nothing for you to add, I guess, Regina. Is there a sort of minimum yield that you're looking to earn, maybe before, after costs and defaults, either in the SME space or in consumer lending? Do you have certain, let's say, thresholds that you would like to make, and otherwise you want to have a look at the deal?
Yeah, I mean, we have different pockets of capital, different funds to invest from, but generally our target returns are in the low to mid-teens. Now, that doesn't need to be on an unlevered basis. We do have access to leverage for certain deals, but then that's only really worthwhile if the deal is large enough, right? If we're talking about 10 or 20 million deal, it doesn't make sense to get leverage, first of all, because we would pass on too much of the absolute economics. And secondly, there's probably no one to get leverage from because it's, too small for the banks to get out of bed from. So it's, that's what we need to solve for. And yeah, depending on the deal and depending on the risk profile, but yeah, local meetings for us.
So we have a minimum return, so it's around like maybe 11-12%, depending on what cap structure we can put in place. But it's much more on a rated basis. Like it is, I mean, on small transactions, it's a little bit easier to price it because you are a price maker most of the time. But you do have some crazy price expectations. Not what I mean is not people saying, "Oh, I need really cheap money." Things that are risky are not necessarily priced as risky assets. So things that people know really well tend to be like literally overpriced, i.e. Near prime consumer tend to be done too cheaply sometimes. Whereas things like we do quite a bit of rent factoring, so it's almost a second charge over your house against a rental contract. And this is done at yields that should be a lot lower than what it is done at, for example. And I think the main issue is that there's a lot of, I would say, not necessarily super professional credit investors who have, I'm not saying this negatively, I'm saying the objective is not necessarily to optimize profit for some players. They might have an objective of a more community involvement, making sure that an economy is growing in a particular way, a political ambition, and so on. And as a result, pricing can be quite different from what people have in expectations.
I mean, I can only add that the valuation perspective, we see the ballpark, what you just mentioned, but the environment seems to be very competitive, and we have post-valuation discussions with clients to work on and improve the valuation, adjust the input factors in order to show the fund performance competitive too. And this takes almost more time and effort than actual valuation what we do.
Yeah, I mean, since we are, essentially an analytics business working with many different investor types and non-bank lenders, we don't have any specific kind of return target as such. But what we see pretty frequently is that kind of the most investor demand, let's say from, family offices and the like, seems to be somewhere on a relative basis from an absolute perspective, compared to high yield plus probably 250 or 300 basis points. So that seems to be kind of the most frequent return target that we see.
Okay, very interesting. Thank you for sharing. This sort of brings us to a similar point, which is the impact of the base rates, let's say the swap rate, as we've moved from a zero interest environment to, let's say, 2.5% as of now in euro. I've got the feeling that it didn't impact lending or financing rates, returns that much as one might have expected it to do. Is that something you share, or are you of a different opinion?
Yeah, I can kick off there. I think it's still probably too early in the tightening cycle to see the proper impact from that. I think in the medium term, what we'll probably see, and that's my personal opinion, is an increase in net interest margin from the originator's perspective, because they don't necessarily have to lower their pricing versus their end customers, versus their borrowers, while funding rates will eventually go down. So that would be beneficial for the platforms. Well, if we were going the opposite way, which we were a few years ago, right, then there was more pressure for the platforms to increase pricing to their end borrowers. But at the same time, they were some originators were reluctant to do so because they were afraid they would lose some customers and they would lose volume. So that saw them squeeze their net interest margin. So yeah, I think in the medium term we'll probably see more of an impact, but yeah, I think it's probably still a bit too early in the cycle.
In 2021, I remember having a discussion with one of our originators asking me, why are you putting the base rate in your price? Because it's always zero. And I had to explain to him what's the base rate. I mean, the essentially the guy, all his life since he left university, the base rate has been 0%. And then when it increased to 3%, for them, it was the end of the world. I said 3% is barely the inflation. And essentially it was the end of the world because he couldn't transfer this price increase to their customers. So we had in 2022, 23, it wasn't really, it was a bit tough on the net interest margin. 2024, 25, so we have the reduction of base rate and they all became experts in it. So what I mean by this is they make sure that their clients never heard about base rates and they're not transferring this decrease of base rate to their clients. But I don't think it's going to be forever. I think competition is going to pressurize this, but yeah, we clearly, I mean, at least on our portfolios, we clearly don't see this transfer back to the client or to anyone yet.
Yep, same, yeah.
Yeah, absolutely.
I mean, it's kind of like your retail bank, right? Where you have your deposits. The moment the interest rates go down, you get an email saying, "Oh, your deposit rate is going down." But if it's going up, you'll get the email in about a year's time with your deposits are going.
Yeah,
so
that's something I recognize exactly. Just a question: who would be better off, or who will be able to withstand the reduction in margin? Is that going to come from the investor, or do you think also that platforms, due to higher efficiency, will be able to cope with lower margins?
I think at some point for the platforms, it's going to become a necessity to become operationally more efficient. Because, I mean, depending on jurisdictions, but for some originators, we see pretty substantial fee structures still up to date. But yeah, I mean, then it's ultimately what, as an originator, you're solving for is kind of you're playing on the demand elasticity, right, of the credit as a function of kind of the interest rate, and then depending on how you adjust your pricing at some point, if you want to target especially, the more prime segment and the more you're competing on probably a bank level for higher volumes, then at some point you have to become operationally efficient. So automation and newer tools are probably going to be the key drivers for platforms to succeed in that space. So I think over time originators will have to make it work with tighter margins.
I also actually think that will be I think there will probably the investors who will have a lower margin because with automation it could be more AI and there could be also more compliance cost, more cost for regulatory reporting, and this is something which not necessarily will be compensated fully by the automation effort. So I think at the end of the day, if there's no new entries in the market and more provider there and competing for more the same investors, then probably the investors will agree to take lower margin and keep clients.
I guess to Regina's point, I agree to an extent, but depends on the investor, right? Because if we're talking about a bank that they have to basically cover their treasury costs and make something on top of that, that's probably easy and to your point. But if it's really private credit, then in order to attract lower yielding capital or lower returning capital or capital with lower target returns, you need a pretty long running before that in order to raise that capital, find the investors, convince them that, okay, this is the right price point. And then on a macro level, right, what are you competing with? You're competing against probably the S&P, right? Because why would I raise capital at 6 or 8% if that investor can invest in the S&P? Of course, it's not going to work forever, but I think there is a floor where private credit can raise capital. But that's why I partially agree, and it depends on the end investor really, and then that depends on the scale of the platform. right?
I think Yen from Citi was talking about that there's not lots of investors at the equity level for platforms, and the main reason is that over the past couple of years it has been really tough. A lot of people, it was not the right people in the teams of the first batch of lending fintech. Now it's very different. You had very few lenders, so the money was expensive. The cost of operations, like let's remind us that when Funding Circle was invented, there were no API to or Codat or this type of things. They had to do everything themselves. So today, if you think about it, big picture, to make it simple, you deploy at 20%, the base rate is 2%. Let's say so you have 18% margin. You are going to have roughly, I would say, big ballpark, 9% for the funder and 9% for the platform, okay? The platform, normally when they start, they have 8% of operational costs, so they make 1% of net interest margin. With now the experience, the fact that you have AI that can clean data and do a lot of things that used to be manual, with the fact that you have new funders, honestly, I think it's one of the best time over the past 20 years to invest in equity in platforms. Their net interest margins, for many of them, goes from 1 to 7%. It's not 6% more, it's 700% more. And that's what I think a lot of people are missing. There's a lot of consolidation happening. It's done under the radar by like big private equities that want to hide this game. It's extremely profitable to them. So really there's something to play. And it's a volatile market. What I mean by this is 2 years ago, it was the opposite. It was the worst investment, I think. Now it is, and I don't know what's going to be in the future, but I think there's a wave to ride right now.
Very interesting. Thank you. Just a few weeks ago, internally within our firm, I was doing a presentation and I looked up some numbers, and I was really surprised to find a chart showing the portfolios or the amount of capital invested in private debt versus private equity within the 10 largest private equity firms. And out of the 10 private equity firms that were mentioned there, 8 of them had more money deployed in private debt than they did in private equity. And those were the names that you would normally associate with private equity. So I was really surprised to see that. And the only 2 exceptions, by the way, were European. And from there, you can see that the Europeans have a lot of catching up to do. So I thought that was a pretty interesting figure. And also, I've stumbled over some numbers where the amount of non-bank lending, the market share of non-bank lending of the total financing capacity or needs within a country was depicted. And in the US, it was around 50%. In the UK, it was 60%. In Europe, it was 10, except for the Baltics, where it was 30. So that sort of confirms the let's say spearheading of the Baltics in this regard. So I thought that very interesting. It also shows that there's a lot of potential for non-bank lending in Europe, in my opinion. And I think there's a lot of catching up to do. And maybe that's a nice point in handing over to you guys in your take. What do you think the landscape is going to look like, bank versus non-bank, and how it's going to develop in the next years in Europe?
I mean, I think there will be partnerships more and more. I mean, just looking like, I don't know, I mean, JP Morgan and PayPal and then Goldman Sachs and Apple, and I think we were working with other company who, UK company who basically invested in vehicles who were then lending to a consumer. And I mean, those partnerships, bigger or smaller, it's probably something we will see more and more.
Yeah, from my side, I think there's still scope for innovation. There's also still scope to just replicate a product that has been successful in another jurisdiction and set up a fintech lender in a jurisdiction that you know well, that you know the regulations, that you know the law, that you know how the customers or SMEs behave. So I think that will change to your point, that 10% will increase over time. But yeah, I think it's probably going to be a slow increase and not all the way to the 50 and 60% that we're seeing in the States and the UK, respectively.
Something that Daniel would not tell you, because all US funds, and I think it's a big wake-up call for European funds right now, is European banks should actually run a lot faster, because there's something happening at a very rapid scale. Is the US funds, Apollo, KKR, Fortress, Aris, all those guys, they're setting up insurance companies. I think you know many of them, like Athena, etc. And they're actually acting almost as, I would say, banking providers. So they have access to very cheap liquidity from pension funds. They have access to indirectly deposits and so on. And they are a lot more motivated to deploy. And on top of this, their money of those US funds are coming from European banks, European insurer, European pension. So essentially, they are coming with a model that is working really well in the US, because banks in the US have been, apart from a few, have been very absent to that for a long time. So they have good practice. But European asset managers are so far behind in understanding this. And the Americans are moving super fast. So I would say it's more this to watch out right now, and to be on the right side of this little battle.
Fair enough. And I would just, bringing it back to the original question, how is the landscape going to look like in terms of non-bank lenders versus others? So I would probably agree that there is a lot of headroom for non-bank lenders to grow, because even in an overbanked market like in Germany, we see kind of non-bank lenders on the rise, because they are just serving to a very critical part of the real economy that is just not getting efficiently served by traditional banks. So I think the case is very much still intact. And at least most of the feedback that we get from non-bank lenders is access to funding, to cheap funding, scalable funding, right? So that brings its own challenges. So yeah, I would guess that number from the current 10% is going to grow. Probably not as fast as we would think it is, but definitely going to be higher in the next few years.
Thank you. One final question. It's sort of a question that came popped to my mind this morning as we were discussing level playing field. So far, we've only discussed it in terms of jurisdictions. I was wondering, is there do you have a view on the regulatory arbitrage between different, let's say, financing or financing providers? When you look at the different categories, is there for instance, if you do an ABS transaction, you have to keep 5% as a risk retention. Many of the platforms that I'm involved with, they don't have let's say, skin in the game. They just originate to distribute, and if a bank would do the same, they would have to just to do the lending. They need a certain capital structure. Do you have a take on that? Is there a certain advantage, and is this a driver for growth?
I wouldn't necessarily say so, for one main reason, and that's you can create and devise structures that work for your own investment strategy, as long as they work for the end borrower as well, right? And that's why you see an increase in forward flow transactions as well over the last couple of years, right? Because it's a solution that works for originators that want to sell assets and lock in an upfront premium, or or at least be capital light. And it works for certain investors, right? Where if you believe in the assets and your underwriting of these assets, then you want to keep a little bit more of the upside of that transaction. So of course there are certain regulations that you have to follow depending on the structure, but again, right, there are ways to structure around those if one of them is a huge restricting factor for one of the two counterparties involved, and then you either move to another structure or the borrower will find another provider that doesn't have that restriction, or the investor will find another originator to work with that doesn't have that restriction on their side. So I think it's a very big market now with a lot of capital available and a lot of capital that's being like sought after by platforms. So ultimately it's about the match. I wouldn't say so. Is my short answer to your question.
And I'm very much agree with you. There is always solution for what client needs.
I think the main arbitrage is actually along this line so far that I see is when an alternative lender is looking at the cost of a debt facility. Sometimes they are misled of not looking at it on a relative basis. I explain. Their cost of equity is very high. It's VC high. Okay, so VC invest to make 10x in 5 years. Whereas Daniel's fund, my fund, or any other fund, or mezzanine might be expensive, but it will be significantly cheaper than the cost of the equity. And even on the first loss basis, the first loss is a little bit of a difficult one because the alignment of interest is more important than the economics. But let's put this aside, it will still be the same. So you could be on a forward flow at 20%. That will be cheaper than a senior facility at 12%. Like it's, maybe I exaggerate here, but it's the rated basis, I would say, is where, for example, I see how much experience the team has. If the team catch this really quickly, I know I'm dealing with people who really understand those issues, how banking works, etc. People who don't come from the industry and are running a lending fintech, they tend to make this mistake. Like, no, I want the cheapest 50% LTV, the cheapest funding, but they don't realize that it's actually very inefficient for them, especially if they are growing fast. If they grow slow, they can manage. If they grow fast, it could even kill their business.
Very interesting. Thank you very much. It's 21 minutes past 2 o'clock. So no overrunning here. I'm not sure if there's any questions from the audience, and I'm very happy to see that I only see very little people watching their iPhones instead of listening to our discussion. So from that, I conclude that it must have been interesting. If there are no questions, thank you very much, and talk to you guys in the coffee guide.